Welcome. I'd like to welcome everyone today to the ISTAT Learning Lab, where we're going to be discussing the aircraft and engine asset-backed securitization business, or ABS as it's well known. My name is Peter Negline, and I'm based in Singapore with BOC Aviation. I'm also a director of ISTAT, responsible for the ISTAT online product. It's a pleasure to have all of you with us today to join this learning lab. And in particular, we are all very lucky to have two well-informed, experienced presenters. Firstly, I'd like to introduce Evan Wallach, who is the President and CEO of Global Air Finance Services, which is an advisory firm to institutional investors investing in bonds and other securities issued in the aircraft and engine issued by aircraft and engine leasing companies. Evan advises aircraft leasing entities on the purchase, sale and financing of aircraft and aircraft engines. He's devoted his short 35-year career to the aviation industry, I should say, specifically in positions in aviation bond sales and trading, investment banking, debt capital markets, and aviation debt restructuring. Evan is joined today by John Mowry, who's a managing director of Alton Aviation Consultancy in New York. John has 2 decades of aviation industry experience. Most of that time he has been providing advisory consulting services to his customers. In his work, he is a subject matter expert to aircraft operators, lessors, and equity and debt investors on a wide array of aviation asset classes, including aircraft, engines, and inventories. John is also an ISTAT certified appraiser. Now, at the end of today's presentation, there will be time for Q&A. You're probably all familiar with this function on Zoom, but there is a button at the middle of your screen, and I would encourage anybody listening live today to get their questions in or place them through that Q&A button. I would also like to encourage our audience to provide feedback, comments, and suggestions, and you can do that by emailing us at istat@istat.org. So with that, let me hand it over to Evan and John for their presentation. Thank you very much in advance. The floor is yours.
Okay, great. Let's just get the screen up. There we go. Thank you. Thank you, Peter. We want to welcome everyone to the ISTAT Learning Lab entitled Intro to Aircraft ABS. As Peter mentioned, my name is Evan Wallach, President of Global Air Finance, and John Mowry is Managing Director and founder of Alton Aviation Services. So our focus today will be primarily on introductory members to ISTAT members who may be less familiar with aviation financing, who are looking for a basic understanding of aircraft and engine ABS. Just as a quick note, if you could answer those 2 questions that you saw before the screen came on, you probably don't need to be on this call, but we're glad you're here. We could easily spend many sessions on this topic. However, we only have about 60 minutes to cover the basic structure of an aircraft ABS issue, the many different parties involved, the importance of aircraft ABS to the aircraft and engine lessors for funding and for trading. And then we're going to have a brief discussion comparing the recent performance of aircraft ABS bonds before the pandemic hit, and then how the bonds have been performing since that time. So I got involved in aircraft ABS back about 20 years ago as an underwriter, and then spent many years in secondary sales and trading, and most recently as an investor, as a co-investor. John, do you want to give a quick synopsis of your involvement in Air ABS?
Sure. Thank you, Evan. I've had the opportunity to contribute to a wide array of ABS transactions going back to 2004. Principally is providing independent maintenance cash flow forecasts, which we'll see as we walk through some of the deal structures are an important element of the cash flows that pay the bonds.
Great. Okay. And just one clarification, even though we're going to be using the term, aircraft ABS, this definitely applies to the many engine ABS deals that have been done as well. So just for simplicity, we're just going to call the transaction aircraft ABS. So we're going to go over, as I said, a basic introduction, a deal structure, recent changes, and then talk about outlook. So just to put things into context for those who are unfamiliar, with the ABS market and the aircraft ABS market. I mean, aircraft ABS is a tiny financing structure within the much bigger ABS world. That includes mortgages, credit cards, loans. As we're highlighting in this particular slide, if you look on the right-hand side, the total ABS issuance in the last 5 years was about $2.5 trillion. We're only about 33 billion of that. So you can see that, we're a little over 1% of the much larger ABS world. But within our own world, if you see, we go to the next slide. You can see, we're an important part of the aircraft financing business for financing our own growth. But even within the aviation sector, aircraft ABS is still relatively small compared to, unsecured bonds in the private placement market and the loan market as well. But what we want to highlight is that if you look at the slide on the right, you can see the growth in aircraft leasing from 1992 to 2020. I mean, right now we're probably 45, almost 50% of all aircraft, is under some kind of operating lease. And if you look at the growth of the Air ABS financing vehicles from, say, 2010 to 2019, you can see that there's a direct relationship that as the global aircraft leasing business has grown over the last, substantially over the last 5 years, the aircraft ABS issuance has grown substantially with that as well. So I just want to highlight that correlation. Okay, next slide. Again, just for basic introductory purposes, the aircraft ABS structure that John's going to talk in detail about, we're basically putting together 25, 30, 40 aircraft into a trust. The trust has initially contracted lease contracts that go with those aircraft from day one. So the modeling involves, the initial contracts, plus there's a tremendous amount of forecasting that goes into the modeling as well of an aircraft ABS deal, as we'll see later. And the other, obviously, major, component is the servicer, who they are, what their capabilities are, what their motivations are, and how they will manage the portfolio once the bonds have been issued. So the schematic on the right is, just a snapshot of, what the deal structure will look like at issuance. Okay, next slide, John. Just want to highlight, the benefits to both lessors and to the aircraft investors that are involved. So for the big lessors, aircraft ABS is critical to their portfolio management business. I mean, it allows a large lessor to dispose or sell, of a large block of aircraft at one time into a trust. It gives them the ability to manage out of aircraft that, let's say, they want to move out of. So for them, it's a very important portfolio management tool. For the mid and smaller lessors, it's an opportunity to basically come up with lower cost financing for the aircraft portfolio. So when you look at the blended cost of capital of an Air ABS deal, it's probably a little bit less expensive than if the same lessor had to go to the private placement market or to the bank market as well. The deal gives the servicer, in this case, if it's a big lessor selling into a trust, fee income. So all the servicing fees go forward to the lessor for servicing the portfolio, collections, sales, etc. It also allows the lessor to maintain lessee relationships by creating this off-balance sheet type of structure, and that's very important going forward for the big lessors as well. And then also for the small lessors, it gives them the ability to establish relationships, with a large group of lessees. And then it's a diversified funding channel as well, just one more financing tool for financing against the assets. From the investor standpoint, the aircraft structure gives an investor an opportunity to basically pick and choose where they want to be in the capital structure. So depending on the aircraft type, the servicer, the jurisdiction, the characteristics of the aircraft portfolio, it gives an investor many different choices as to where they want to be in terms of risk return profile for the bonds that they're buying. So, and then also it provides a liquidity feature, even through the e-notes, when things are good, there is a liquid market for trading out of the position if you're uncomfortable with it. Okay, next slide. So, John, we wanted to give some historical context, to the Air ABS sector. So it really goes back about 30 years, beginning in the 1990s. And it emanated from the big mortgage financing structures, the credit cards, again, it evolved from what was going on in the much larger ABS world. And I think some smart bankers and some smart lessors got together and said, if we can do it with mortgages and credit cards, why can't we do it with airplanes and, and even engines? So the initial deals were more financial mimicking of the larger asset classes, that we saw. Very aggressive pricing structures, very high LTVs, very slow amortizations, variable pricing. And, the issuers were just a handful of the big lessors at that time. There was a very limited investor base. But believe it or not, the structures were actually performing fairly well initially until, unfortunately, 9/11 occurred. And, that just completely shut down, not only the Air ABS world, but also shut down the big asset-backed securities world as well. In the second period, so, 2002 to 2008, again, not that much innovation. There was a push to bring in some new investors by putting what we call monoline wraps on the senior tranches to basically transfer the risk from the assets to an insurance company. The deals were okay, but I wouldn't really say it was that big of an important structural financing tool for the aviation industry during that time. And then of course with the Great Recession, again the ABS world completely shut down, as did the Air ABS world. So if you look at this last phase, 2012 to today, the first issues sort of came out, pretty conservative structures in 2013, 2 tranches, straight line amortization, fixed rate pricing, maintenance forecasting. The deals had refinancing targets, cash flow shortfall triggers. I mean, what we saw was, I would characterize as an evolution that now where the financial structures were now, more being driven by the aircraft leasing business as opposed to the other way around in the previous periods. So, we had many new lessors coming into the market, not just the big guys. And of course, we had a much bigger expansion of the investor base, which was very important. All right, John, next slide. So this is a snapshot. I wanted to highlight the last 5 years. And I think what jumps out here, as you can see, many new lessors, many new issues. The asset portfolios now included freighters, regional jets, turboprops. Of course, the engine business really became critical as it is today. And if you look at the right-hand side, you can see that some names we'd never heard of before: Castle Lake, Carlisle, Apollo. They became some of the biggest issuers of Air ABS. Of course, these were, experienced aircraft leasing guys, that came out of some of the big leasing companies. But at the same time, they were taking advantage of the new structures for their portfolios that they had. And I think that the innovations that were put in place at that time basically got investors much more comfortable with the structures and the deals. At the same time, you know, GCAS was a big issuer, Air Lease, BBAM, you know, as we mentioned earlier, exploiting the the structure for portfolio management purposes, getting sale treatment, moving out of older portfolios as well. So you really started to have a much more diverse number of lessors and issuers. If you look at this list, 20, 25 new names. And again, the aircraft portfolios went from new, midlife, older. It was really a big variety. And with this, you could almost say there was a generic structure that was starting to be formed, where investors were getting very comfortable, with the basic risk and structure of the deal. And as this comfort level permeated, the pricing also reflected a reduction. So pricing started to come down as well. I mean, one point I just wanted to bring, I left out earlier, was for investors, the aircraft ABS deals provide a slight premium to them versus your generic, similarly rated, mortgage or credit card. So for the investors that want to do the work, they were basically buying, an A tranche or a B with the same rating, but getting a slight, premium on yield pickup for that position. But once again, just to look at it, so relative to the big ABS world, we were pretty small, but we were getting up to, roughly 25, 30 billion of bonds with a much deeper investor base up until the pandemic hit. Okay, next slide. And again, just one innovation which was significant, which we saw, in the last couple of years, the creation of the tradable e-notes. So your traditional deal, you had bonds issued through, say through a C tranche, 85%. The equity was either, if it was a debt financing, the equity was the issuer. And if it was a new deal, it was basically one or two big investors that were coming in as the equity. With the e-note, I think what we saw was that investors were saying, we'd like to participate, in the upside of the aircraft leasing business as well. Can you guys create something that, where we can participate? So I think the bankers, once again, very smart. They got together and created what has become the, a tradable security of the equity in the ABS deals. And again, this expanded the equity base. And one of the hooks here was that for an investor, they can trade it. It becomes a liquid security in good times. In bad times, obviously, it's not. But at least during better times, normal times, like the bonds, the e-note also became a tradable security. And again, this was a way to expand the investor base, to bring in new investors. So with that, that's basically just I'm going to turn it over to John now, and we can go through the deal structure of the transaction. But one thing I wanted to highlight before we turn it over to John is that unlike a mortgage structure or even a double ETC, where basically your assets are fixed, your schedules are fixed, your lessee is fixed, an aircraft ABS deal is constantly changing. And there's constantly, tension between the various parties in the structure that impact the cash flows that come into the investors. So, when, even though these are portfolios which are intended to be diversified globally, and they do work during more normal times, when something like the pandemic hits, it's a true test of how the bonds perform, which is what we're going to talk about a little bit later. So John, let me turn it over to you and go through the deal structure slides.
That's great. Thank you, Evan. As Evan had shared earlier, and as the name implies, the securitizations are backed by or collateralized by certain assets. And in the case of aviation, these assets are the aircraft or the engines that are subject to operating leases. Pursuant to these operating leases with the airlines as lessees, the assets will generate cash flows that are used to pay back the investors. Every party in these transactions is carefully thinking about three dimensions: the leases, the credits, and the assets. So let's just start with the leases. Essentially, all of the aircraft that enter into the ABSs are on lease at the start. And the contractual terms of those initial leases have the single largest impact on near-term cash flows. Lease rent is usually the largest driver. It's typically payable on a monthly basis, on a fixed rate basis, but there are also leases that can be floating, they can have stepped rent, paid quarterly, or as we've seen recently, we've seen the introduction of power by the hour types of rents. All the current leases will have a contractual term remaining, but this can be impacted by certain options, such as an early termination or a lease extension option that will change the duration. Maintenance-related cash flows also present through these structures as very meaningful elements of a lease agreement. A lease that requires the payment of maintenance reserves each month and potentially reimbursements is very different from one that requires end of lease compensation payments at the end of the lease. The cash flows throughout the term and at the end of the lease will be very different in each situation, not only in the case where the lessee performs, but most certainly in the event that there were a lessee default. I think importantly, it's important not to think just about the provisions within a specific lease and the cash flows of that individual lease, but it's also important to think about the risk associated with concentration around lease expiration dates, for example. It's perceived to be highly risky to have a significant proportion of the aircraft leases expire within a narrow time frame, because that period might coincide with a recession or a downturn and subject the portfolio to remarketing in a soft remarketing period where lease rates are low. So a widely distributed schedule of lease expirations can minimize that risk. If we just turn now to the middle column and with respect to the credits that are in the ABS deals, the lease terms can only hold value for the lessor and the investors if the counterparties have the means to honor their parts of the agreements. A contractual rent that is significantly over market is not particularly beneficial if a restructuring is underway or it's likely. Formal quantitative credit analysis of the lessee financial performance metrics, evaluation of country risk, qualitative insight into from years of experience is essential to making informed decisions about the creditworthiness of the counterparties. In addition, as we don't want to see concentration in the expirations of the initial leases, it's very important not to concentrate and put all of the eggs in one's baskets with respect to the lessees. So again, we look this for diversification on the individual lessee and also within the regions. Shifting to the assets at the far right, one needs to consider the market risk and also redeployment costs. So first, just with respect to remarketing risk, what happens at the end of the lease when it comes to a close, either on a scheduled basis or an unexpected early termination? One needs to think carefully about what is the expected liquidity of the asset. What will be the age of the aircraft be when that remarketing is required? Will it go back out onto lease or will it go for retirement? How long will it take? What will the downtime be until redeployment can be achieved? Most certainly, what lease rates will be achieved and what will be the term of that lease? Will it go back out on a short 3-year lease or is a 6-year lease more expected? What is the expected creditworthiness of the counterparty at that period of time? And will that counterparty pay maintenance reserves or will they make end of lease compensation payments? And then finally, ultimately, what is the residual value of the asset? Should we expect that the aircraft will go through part outs and green time leasing? In addition to thinking about those characteristics around the remarketing and the future lease cash flows, lease rent generation, we also need to think about costs associated with the transition. And here we're thinking about principally about interior reconfiguration costs, which can be very significant if moving from a highly specialized interior, perhaps with a 3-class cabin interior in a wide body, that needs to move down to a 2-class or a single-class wide body conversion. Costs can be $10 million or more. In addition to that interior reconfiguration cost, we also need to think about transitioning aircraft between jurisdictions, because in some instances, the aircraft configurations can require a meaningful amount of spend. But looking at each individual lease, credit, and asset individually is important, but we have to do this holistically as well. Lessors, when they're looking to sell aircraft, either through a trade sale or through the financial markets with an ABS issuance, do so, as Evan mentioned, to manage their exposures. They're always looking to trim and to prune their portfolio where they see excess exposure. This is something that we traditionally call a sweet and sour type of deal. It's not unusual in these ABS issuances to see some favorable transactions or some favorable combination of underlying leases, credits, and metal or assets. For example, we might commonly see a wide body aircraft leased to a strong airline lessee, but the term might be very short. On the other hand, we might see some very latest technology aircraft that are very young with a very long lease term remaining and an attractive rent, but the credit of that counterparty may suffer. So again, it's that combination that needs to be evaluated of the leases, of the credits, and of the residuals, the metal. Just flipping to the next slide and taking a step back to look at the broader ABS market, there are many different types of asset classes outside of aviation that use the ABS structures. Aviation ABS is somewhat unique in that there's a very low volume of assets, and each of those assets has a high unit value. For example, a characteristic $500 million ABS issuance might have 20 aircraft valued at $30 million each. We can contrast this with an auto loan ABS issuance, a recent one by Carvana, totaling debt issuance of $420 million, had nearly 20,000 discrete asset-backed loans, each valued at around $20,000. So when there's a very wide array of underlying obligors, the performance of the securitization isn't dependent upon the performance of just a few credits, as is the case with aviation ABS. So what we see in the aviation ABS structures are concentration limits across certain parameters. And a few examples of these are shown on the screen. So at the top left, what we can see, there can be some limitations with respect to how much of the aircraft can be leased to a single lessee and how much of the aircraft can be leased to the top 3 lessees to control the exposure to a specific name. At the bottom left, we see an agreement and a commitment not to lease a certain proportion of the aircraft into any single country. 25% is a cap, unless that country is a highly creditworthy, has a strong jurisdiction, easy to repossess, typically developed countries. On the right, what we see are regional concentration limits. And so the ABS structures generally will sign up and commit to having a smaller proportion of the portfolio allocated to the emerging markets relative to the developed markets. Importantly, these concentration limits will hold at issuance, and they also are requirements to be held throughout the term of the lease, and the servicers need to manage to these concentration limits. This next slide shares some perspective on the diversification that we manifests itself in the wide range of deals. And in this case, the sample set of deals that we're looking at are all those transactions that have closed since 2015. What we see is that the ABS asset class composition is really a microcosm of the broader aircraft and engine leasing market. In the top left, what we see is that narrow body aircraft, which are perceived frequently to be the most liquid and the most popular assets, account for the vast majority, almost 75% of the total asset value. It's the A320, in the bottom left, what we see is the A320, the 737-800 that account for more than half of the total issuance value, followed by A319s, 321s, and other members of the 737 NG family. We can see at the top right, the wide body assets have accounted for nearly 20% of the total value. These are often sprinkled in. We haven't seen an exclusive wide body dedicated ABS issuance, but the wide body aircraft are sprinkled in to the broader ABS issuances. The aircraft types that make these up include the A330-200, the A330-300, and the 777-300ER. We've also seen specialized assets for securitizations. For example, the regional aircraft lessors Falco and Elix have both come to market with regional only aircraft, some including jets and some including turboprops. We've seen BX Capital come to market in 2018 with an all cargo aircraft securitization. In addition, we've seen a significant number of engine securitizations being issued from GCAS, Willis Lease, and White Oak. Following industry best practice, ABS portfolios usually have a diverse composition of lessees, and we can see this in the chart at the top right. The three largest lessees that have featured in all of these issuances since 2015 have been relatively strong names: Qatar, American Airlines, and GOL. But as we look through the balance of the top 10 names, we see some more challenged lessees, such as Garuda, which is currently experiencing challenges, Philippine Airlines, which recently filed Chapter 11, Asiana, and Alitalia, which is in bankruptcy, the latter in bankruptcy as well. Of course, what we're showing here is a very wide distribution and diversification across lessees, and quite interesting to see that more than 300 total initial lessees have been part of the aircraft and engine-backed securitizations. But when we look at an individual deal, obviously the concentrations are much more intense. Just down at the bottom right, in terms of issuance, what we see is a widespread distribution of the aircraft ages for the aircraft that are coming into the market. And again, we think that this is sort of a microcosm of the broader aircraft leasing portfolios. Approximately 35% of the total value of the issuances have been associated with aircraft less than 5 years of age. Another 30% of issuances have been associated with aircraft in the 6 to 10 years of age, and it steps down from there. Moving on to the next slide. For an individual ABS transaction, whatever the selected portfolio of leases, credits, and assets are, they will generate an expected series of cash flows. And in the chart on the right, we've summarized what these might look like for a representative transaction. We've assumed here that the aircraft are leased for 7 years, and then they're sold or refinanced in that 7th year. What you'll see from the chart is the main inflows that are coming in are the lease rental payments, shown in darker green. These are typically the monthly rent payments that come from each lessee, and they'll adjust, of course, when one lease ends and it moves on to the next lease. The maintenance-related cash flows, which we talked about, are seen to be significant in this representative portfolio. What we see is relatively steady maintenance inflows coming in monthly for maintenance reserves, and then lumpy inflows coming in when end-of-lease payments are due. On the outflow side, what we see on the maintenance are fairly lumpy outflows, which are required when maintenance reserve reimbursements and lessor top-up contributions are required. It's important to keep in mind as we talk through the structure that typically the cash that is associated with the maintenance reserves that have been paid in do not transfer to the structure at issuance, but their liabilities do, and these need to be funded from future cash flows. Other important costs that enter into the transaction are transition costs, servicing costs, and other administrative costs. All of the cash that is collected by the trust, the ABS trust, in the form of rental receipts, maintenance reserves, end of lease payments, and proceeds from the sales of aircraft are used by the ABS to make certain payments. There's a specific document that's unique to each transaction that's called an indenture, and it specifies precisely the priority of payments, how the cash flows received are to be paid out each month. This is what's known as a waterfall. And on this chart here, we've graphically depicted what a representative waterfall looks like, showing that priority of payments. At the very top of the chart, you can see a blue box that represents all of the cash collections coming into the top. At each subsequent step in the waterfall, if there is sufficient cash, payments are made. The very first step in that waterfall distributions are what's called required expenses. These are expenses that are deemed critical for the function of the ABS trust. It includes administrative managing agent fees, servicer fees, operating and administrative expenses, etc. Before I walk you through the rest of the waterfall here, I'll take a brief step back and note that typically aviation ABS transactions have 2 or 3 tranches of debt that are issued. And in terms of nomenclature and priority, these are typically termed a Series A note, a Series B, and a Series C note. As you'll see on this waterfall chart, the payment of all Series A interest and principal always comes before in advance of Series B and Series C note payments. Because of this position and its priority in the priority of payments, it has lower risk and it's more likely to be paid than the Series B or the Series C notes. Because it's lower risk, it typically attracts a higher rating from the rating agencies and it offers investors a lower coupon. Coming back to the chart, after the required expenses, we see the Series A interest paid and the Series B interest paid. Following those 2 interest payments, certain reserve cash accounts need to be funded. ABS issuances that have been part of the 3.0 generation that Evan talked about earlier typically have a credit facility that's extended by a bank intended to cover temporary shortfalls in collections where the transaction is not able to meet interest payments on the Series A or Series B notes. If this liquidity facility has been drawn down, then the structure of the waterfall requires that it be replenished after making Series A and B interest payments. Next, we see the senior maintenance reserve accounts and the security deposit accounts. These transactions with respect to maintenance have a look-forward mechanism that can look at future expected maintenance expenditures that will need to be funded by the ABS, and they ensure that the trust accounts are building up enough cash to be able to make those upcoming payments that are likely to be lumpy and not available from a single month's collections. After ensuring that the reserve maintenance and security deposit reserve accounts are funded, we see principal payments being made to the Series A and the Series B notes. Excess proceeds, as we go further down the waterfall, are associated with spikes in cash inflows that might come in from a large end of lease payment, for example. This excess proceeds step in the waterfall determines which note holders and equity and how the proceeds are to be allocated. Moving further down, we see rapid amortization and a DSCR cash trap. These are 2 steps in the waterfall that serve to turn off further distributions to the Series C and to the equity note holders. And I'll discuss these more on the next slide. Finally, as we continue down below, we see interest and principal payments being made to the Series C notes, any further expenses, and then finally, after all of the other cash flows and obligations are met, any residual cash will flow to equity. This equity, because it's at the very bottom of the waterfall, it's always perceived to be the most risky investment as part of the ABS. And as a result, it's the yield expected, the IRR is expected to be higher than would be through the Series A, the B, or the C notes. As I talked through that waterfall, I mentioned a number of the different structural features that have been introduced to protect bondholders in the event of a default. And I'll just step through some of these features one more time. First, in the top left, what we see is the liquidity facility. As I mentioned, this is a credit facility extended by a bank, and it's sized to cover 9 months of interest payments on the Series A and the Series B notes in the event that there's some sort of disruption to collections. The DSCR cash trap. DSCR stands for debt service coverage ratio, and it's a ratio of cash collections relative to scheduled principal and interest payments. If this ratio declines below a certain threshold for a certain period of time, then cash will be halted from being distributed further down below the waterfall to the Series C and to the equity. any of the cash that gets trapped by this step in the waterfall will then be applied in the next month as if it were a cash collection. Third, a rapid amortization event will cause a reprioritization of principal payments to Series A and then to Series B if any of the following triggers are breached. One, a DSCR ratio dropping below a certain target threshold. Two, if many of the aircraft are off lease. Or three, if the principal is not paid in full by the expected maturity date. Finally, I think it's important to note an event of default, but it's important to note that this is an event of default of the ABS structure, not of any underlying lessee. And it's also important to note that on the Generation 2.0 and the Generation 3.0 ABS issuances, none of the transactions have ever defaulted. But there is a mechanism which states that the structure will default if there's a failure to pay interest on the most senior tranche of notes, or there's a failure to pay the principal by the final legal maturity date. In the event of a default, again, what we see is that there's a reconfiguration of the waterfall. It's called a post-default waterfall. And again, it will prioritize payments to the Series A note holders, then to the Series B and subsequent. Rating agencies play a very important role in the ABS issuance process, along with the sellers, the equity investors, the note holders. At the center of all of this are the investment banks at the outset of the deal, who will utilize a series of expected cash flows generated by the assets together to design the planned debt structure and the equity structure to satisfy the needs of all the constituencies. Evan had mentioned before that there's some natural tension in a transaction between the involved parties. And when a deal gets closed, there's been a meeting of the minds with all constituencies in terms of how to proceed. Remember that the sellers generally want to achieve the highest sale price associated with the transaction as best they can. The rating agencies want to ensure that the structure is capable of paying all of the principal by the final legal maturity date and making timely payments of interest. Bond investors are looking for steady payments at the contracted coupon rates, and they're comparing the risk and reward profiles of an investment opportunity to those of other aviation ABS issuances and to other broader bond instruments that are available to them. The equity investors are generally seeking to maximize their returns, but some may also want a sculpted profile of distributions along the way, or others may be willing to accommodate a lump sum payment at the end or a distribution at the end. What we've shown here on the left chart is a representative series of cash distributions where debt principal and interest payments are expected to be made in each period. The principal balance of each tranche of notes is seen to amortize or reduce in each period with the payment of principal. And ultimately, in this scenario, it's paid off in year 7 when the aircraft portfolio is assumed to be sold or the debt is assumed to be refinanced. In this example, what we can see here are relatively steady and consistent payments of interest and principal throughout the term to the A, Bs, and Cs. But the equity distributions start to become meaningful in years 4 through 6, and then also upon the event of a sale in the assumed year 7. As I mentioned, the rating agencies play a very important role in this space because they're providing independent assessments, principally for the benefit of bondholders, regarding the ability of the transaction to make 1, the timely interest payments, and 2, to fully repay the principal by the legal final maturity date. It's important to note that the ratings don't reflect the ability of a transaction to make timely payment of principal to note holders, and they also are not rating any of the equity notes. Many investors, institutional investors, will have requirements that the debt they invest in be rated by 1 or more rating agency. And with a consistent approach, the rating agencies help investors assess the absolute and relative risk of these bonds. Each rating agency is required to publish criteria that specify how it will rate each type of structured finance product. Because of the unique nature of aircraft ABS, the rating agencies have generally bespoke criteria for this asset class. and they draw on the broader generalized ABS methodologies. From a quantitative and financial perspective, each rating agency will run its own set of stress cases, and these are projections to evaluate how the ABS is expected to perform in the event that collections are lower than expected. Frequently, the rating agencies will run multiple simulations of recessions, and they'll contemplate various recessions throughout the expected term of the structure, where a significant proportion of the lessees will be assumed to default. End of lease payments will not be made. Incremental costs will be incurred to remarket or repossess aircraft. Future lease rates and future values are assumed to be impaired in each of these scenarios. Each rating, such as a single A or a triple B rating, is associated with its own set of stress assumptions from each rating agency and an anticipated probability. If a note achieves a certain rating, then that means that under a specific stress case assumptions, the interest is still paid in the timely manner, and the principal can still fully be repaid by the final legal maturity of the note. In addition to performing the quantitative and financial stress test analysis, the rating agencies are also evaluating the capability of the servicers and the robustness of the legal structure, amongst other considerations. As you can see at the chart at the top right, the vast majority of the debt that has been issued has been rated a single A, plus or minus a notch, and this is more than 75% of the total issuance. From the chart at the bottom right, what we can see is that the average coupon of the different series of tranches changes depending upon the rating. And of all the issuances you can see since 2015, of course, a note that's been rated a single A is deemed to have the lowest risk and therefore the lowest coupon. Continuing our look across ABS transactions that have closed since 2015, just to profile some of the typical characteristics and observed trends that we see. Here we filtered out to what we call the core aircraft. And so these are excluding the engines, the regional aircraft deals, et cetera. Just on the top left, what you can see is that the average ABS that's been issued has raised approximately $400 to $500 million in Series A notes, perhaps $100 million of Series B notes, and 50 million or so of Series C notes. On the top right, we see that the initial LTVs, the loan to values for the A notes, is typically around 65%. It increases by about 10% up to 75% for Series B notes, and then perhaps another 5 or 10% moving towards 85% LTVs on the Series C notes when issued. At the bottom right, what we can see are trends in the coupons for different series of bonds over time. And generally, we see a pretty flat trend in terms of coupons for issuances. But I think interestingly, and we'll discuss further, we see a bit of a downward trend for Series A notes in 2021. And we'll come back to that shortly. But Evan, let me turn it back to you in terms of sharing with the audience how investors are evaluating the performance of these issuances. Thanks.
Great. Okay, John, thanks very much. We've got about 15 minutes to go, so I think we can cover the rest. I guess if we can go to the next slide. So I guess what John went through in detail is, you can see the complexity of it, the many parties involved. In general, that's probably like a 6 to 12 month process that you go through from beginning to end, to issuance. And I think now what I'd like to say is like, okay, now that the bonds have been issued, the bankers are going away, and they're going on to the next deal. Now the real work begins. And this is just a snapshot of all of the many responsibilities that the servicer has to be responsible for once the bonds have been issued. And in addition to the servicer, you have admin agents, you have trustees, you have a board. So there's a tremendous amount of afterwork that goes into managing the portfolios. Reports are issued monthly, quarterly, annually to investors. And so again, from just from a data standpoint, there's a tremendous amount of data. So I guess what I'd like to highlight is that for the small lessors, the deals were structured in such a way that you typically would manage, say, 2 or 3 airplanes a year coming off lease, remarketing, selling, reconfiguring, negotiating with the lessee on renewal. In what we've seen in the COVID environment is that you've had an entire portfolio having to be managed now by the servicer in a very, very short period of time. This is obviously completely unprecedented, but it's been a true test, I think we'll see, of the capabilities of both the small lessor servicer platforms, as well as the big lessor platforms that obviously have a lot more resources, to throw at, at the environment that we're in. But I think if we go to the next slide, wanted to highlight, here's the big problem. So if you look at where collections were in, say, February of 2020, as 100%, COVID hits, and within a couple of months, you're down, on average, to 35% collections of, what was coming in. So if you had 10 million coming in a month, now you've got 3 million coming in. And so when you look at the waterfall that John went through and how that money, is supposed to flow, pre-COVID, money was, collections were coming in and money was going down as far as the equity in many deals. Now you've got 30% coming in. And so you're barely able to cover your expenses, your interest to your A, your interest to your B, and maybe a little principal to your A. And then in addition, as managing 25, 30 aircraft now, the expenses related to that are now much, much higher than what was being forecasted when the bonds were issued. So we're in an environment now where there's truly a test of the capability of the servicers. The chart on the right, again, this is a metric that was put in, in ABS 3.0, and some of these metrics were really important. We were, looking at coverages of 1.8, 1.2 times coverage pre-COVID. Now you're down to below 1, and as you can see on monitoring these reports on a monthly basis, the recovery is slow. And so, we're not seeing a snapback yet to where things were pre-COVID. So these metrics, again, from the invest for transparency, for analysis, didn't really have these metrics previously. So these are, the metrics that John went over before are now really becoming critical pieces of analysis for investors. Okay, John, next slide. For the rating agencies, again, I mean, they were, if you will, required to provide annual surveillance reports for each of the deals on the anniversary of the issuance date. And for the most part, these were pretty much non-events. Principal payments were being made, debt balances were being paid down, DSCRs, were much greater than expected. So pre-COVID, everything looked great. Not going to go over this whole chart, but if you look at, the chart on the left, you can see that in many of the deals now, a principal is the last dollar that's getting paid in the deal. So you're looking at, in some cases, it's just part of the principal schedule, the scheduled principal that was amortizing. So again, you're looking at a structure, structures where, less cash is coming in, and you're covering expenses, but basically your debt balances and your equity repayment is pretty much on hold for right now. As a result, rating agencies have taken quick action. I think for the most part, they've done an excellent job getting on top of the analysis and the ratings proactively, and they're doing what they've got to do. They see a lot more information than the investors do. And they're using it, to make their decisions to, take action in downgrading some of the, certainly some of the junior bonds from where they were. And they're going to keep a close eye on it. And, this is a critical report for investors to keep a close eye on. Okay, John, next slide. Okay, so I think what we wanted to highlight here was the impact of the pricing in the secondary market on the previous issues pre-COVID, and what we're seeing now on issues that were being done in 2021. And we're going to get into a little bit more detail on this, but you can see that the A tranches for the pre-COVID deals have recovered most almost to where they were pre-COVID. They did drop drastically down to 65-70 cents and have snapped back. But the new deals that are coming out, better structures, we're going to go into this a little more detail, better credits, better longer terms. The pricing has actually gotten stronger on the newer deals. But for the most part, for investors that were in the A tranches, there's been a pretty strong recovery back to close to par for the bonds that they were holding. The Bs and the Cs, obviously they're still under tremendous stress, and yet to know where those come out. But for the majority of the bonds, as we show, are in the the Class A's, they've recovered, and investors seem to be right now just sitting tight with what they have. Next slide.
Evan, maybe just to jump in, I'd probably maybe share as well with the audience is that, as Evan shared at the outset of the presentation, sort of the aircraft aviation ABS issuances it's a small portion of the overall bond market. And so I think it's important to have some context as to what's happening with the overall interest rate environment. And the two lines toward the bottom of the chart, starting in blue, would be the federal funds rate. And this is the cost of finance that banks are able to borrow from each other overnight. And what you can see right at the start of the COVID pandemic, it was 1.5%, 2%, and the Federal Reserve cut that interest rate to essentially zero, and that's where it's remained for essentially that period of time. So what we see is that and on the back of that, well, that's a short-term interest rate that has the impact of pulling down as well some of the longer-term interest rates, like the 7-year constant maturity treasury that's shown here. And that, as bond investors are looking at opportunities and assessing the risk, it's always on a relative basis to that U.S. government note that's sort of a risk-free return. And so certainly some of the reason that the interest rates have come down, or the yields have come down on these issued ABSs is because of the strong liquidity that the Fed has put into the markets.
Okay.
So yeah, maybe I can just continue on here, and then
Yep.
Evan jump in. So just in terms of these new issuances, we've seen a very robust level of activity so far in 2021, and there are 8 different deals shown here on the slide that have closed. A number of these issuances are what we would kind of deem the core aircraft issuances. Those closed by Sky Leasing, Merck's Air Lease with its Blackbird 2 securitization would be largely composed of aircraft that were acquired on sale leasebacks during the pandemic from strong credit airlines. These transactions, if you come over to the A coupon column, what you'll see is that these achieved all-time low pricing for any aviation fixed rate ABS issuance ever, at just north of 2.4 or 2.5%. Well, we're going to draw some observations about these core aircraft securitizations. I think we'd also, think that it's important to draw attention to the diversity of the issuances that have come to market. So it's not just the core aircraft with the great credits and the long-term leases. We see in the regional space, Falco came to market with its inaugural transaction. It was only a single tranche of debt, featured a low LTV and a higher coupon, but still shows that there was a market for that type of issuance. We saw 2 engine deals that have closed so far in 2021. One by the large, well-known engine lessor Willis Lease Finance Corporation. This is called West 6, their 6th ABS issuance. Another, which is called Thrust, is owned by White Oak, and it includes a portfolio of spare engines that are managed by GCAS. At the bottom of the chart, the most recent issuance that has come to market that came from Castle Lake, and that's a refinancing of a 2017 ABS issuance, and it was received extremely well. You can look at that A coupon, 2.7%, particularly given that the average age of that portfolio of aircraft was quite extended, 17.8 years on a simple, not value weighted basis. So a lot of diversity that's come to market. If we think, notwithstanding the diversity of the issuances, if we come back to sort of that, what we'll call that core aircraft, the center of the ABS market, I think what we see are strong credit airlines making up a good portion of the portfolios. The chart on the left compares the credit ratings of the lessees that featured in the 2019 issuances to those that have featured in the 2021 issuances, based on the lessee ratings back from 2019. And what you can see is a clear shift where the lessees that are in part of those 2021 issuances are substantially stronger credits, and on a relative basis. What we see is many of the recent issuances have featured large flag carriers, strong LTCs, US majors, et cetera, all with strong balance sheets. And again, a lot of these aircraft would have been acquired during the pandemic on sale leasebacks. In terms of, we're also starting to see more and more new technology aircraft that are coming into the securitizations, be it the 787s or A350s, the A320neo or the 737 MAX family. Part of this is natural because of the fleet transitions that are underway, but that's generally viewed as a solid positive for investors because those aircraft are perceived to have less value volatility and stronger residual value performance. We're seeing longer lease terms in this core market. So as an example, on the 2019 issuances, the average lease term remaining on a simple basis was around 5.4 years, whereas for these 2021 issuances, the average lease term remaining is out towards nearly 8 years of age. So some interesting trends observed on the recent issuances. Then I think maybe just in closing, a couple thoughts, and Evan will jump in to summarize, I think. But I think, overall for the long term, we're all, bullish on the aviation industry. We think, traffic demand comes back and, reassociates itself with economic activity once the pandemic subsides. The trajectory of that recovery, it's very challenging to predict. There's likely to be some bumps along the road. With respect to the legacy issuances on the ABS deals, the junior tranches, are going to be challenged for a period of time. As Evan shared, there's not cash coming in the door that's sufficient at the moment to pay below, a principal in the waterfall. And so, that's the challenge for the issuances. We've yet to see sort of a snapback or bounce back in lease rates for placing aircraft. And so, we expect some challenges to continue on the junior tranches. Taking a step back at the broader market, we see that, the airline balance sheets have generally been weakened and they're in a challenging position. Many don't have the cash and the equity to deploy and to own their own aircraft. And so we're bullish on operating lessors as a whole being a capital provider to the airlines and to the aircraft leasing industry. With the ABS markets open, as evidenced by these 8 issuances year to date, we see the banks are again providing warehouse financing, short-term lending facilities to lessors to help support them building their own portfolios. Eventually, what's typical and what we would expect to see is that the banks will then, once the portfolio has been filled and utilized, the banks will help on a takeout transaction to put term ABS financing on it. We see investors continuing to seek investments that offer some sort of yield premium in the low interest environment, but they continue to differentiate between the different tranches and the different higher and lower credits and the like. I think the final milestone or one of the interesting milestones that we expect to see, and I think would be a little bit more optimistic maybe than some others, would be the return of the sale of an equity note as part of an ABS transaction. We're starting to see lessors are starting, trading was fairly anemic during the pandemic of sales of aircraft between lessors and investors, but we're definitely starting to see that pick up. And just as debt investors are searching for yield, so too are equity investors looking for return. And so we would say for the right pool of assets, leases, and credits, that there may be some interested buyers on the equity side. Probably, most certainly won't start out with the tradable equity note structure where it's widely distributed, or that would be our view. But we might see some single buyer equity ABS issuances to come. Evan.
Great. Yeah, great, John. So I think we're just about out of time. We're going to open it up to Q&A, but just a couple of my final thoughts. Obviously the pandemic has impacted the credit quality of lessees globally. If you look at where we were pre-COVID, I think there was a view that your emerging markets credits, your Philippine Airs, your Garudas, your jets. Yeah, they were struggling, but they were servicing large markets where global traffic was definitely important and growing. And so I think those were big parts of the lessee credit pools. Look, those now have had trouble, and so I think that there's a big group of emerging markets type lessees that now probably can't be as accommodating to them as we were previously in the structures. So I think we have to wait and see how those credits evolve. And I think basically the end of the day for investors, these are passive investments. You cannot foreclose. You can't go in and get your assets. You're totally relying on the servicer, to perform the job of managing the portfolio on your behalf. At the same time, there's a secondary market where if you're that uncomfortable, you can trade out at a price. You can move in and out as well. You're taking, basically, if you hold, you're taking an extension risk, for your bonds. Ironically, some of the phase one ABS bonds, that had a legal, that were issued in 99, 2000, they're still out there. There are a couple that are still paying off. The expected final is 7, but the legal final is 30. So, there is a balance, that investors have to be comfortable with. Again, I think what we're going to see is as the global market of travel picks up, aircraft leasing picks up, we're going to move back. Aircraft ABS will continue to be an important component of that aviation growth as well. So with that, John, thanks a lot. I think we're going to pass it back out over to Peter and answer some questions.
Excellent. Well, thank you very much to Evan and John. It's a fantastic presentation. Really appreciate the work that you've put into both preparing it and delivering it for us today. For those just curious, the presentation or the recording will be available within the next 24 hours, and we'll get the final set of slides available through the ISTAT website for you to download as soon as we possibly can. So please make sure in terms of the on-demand availability, you share it with your contacts and colleagues and so forth, that they can learn from this presentation as well once it's available. Now, there's a couple of questions around the issue of maintenance reserves. And I suppose before we get into the specifics of some of those questions, can we just take a second for you? Can you explain the origin of the maintenance reserves? I presume it's sort of unique to aircraft assets or certainly large capital assets, but why does it arise and why is it so important? It's just an initial question I would put to you.
Sure, I can take a cut at that. So what we see is that the maintenance condition of an aircraft has a very significant impact on the value of the asset. So on a narrow body, the difference between a full life and a run out aircraft on the maintenance can be circa $15 million easily. And on a wide body, that value differential can easily be $30, $40 million. And so lessors in their lease agreements have stipulated that in the event that the airline utilizes the aircraft at the end of the lease, they want to be compensated for any diminution in that maintenance value that takes place. And so they will do this through two basic types of mechanisms. If the airline is not highly creditworthy, then they will require that the airline make payments each month called maintenance reserves to compensate the lessor for diminution in value. And then when they go to perform the maintenance, they will submit a reimbursement claim and ask that the lessor return the funds that have been paid in to improve the value. For a strong credit lessee, typically the flag carriers, there's a negotiation and the flag carrier says, hey, Mr. Lessor, I'd rather not pay you monthly. I'm a good credit. I'll catch you up at the end and I'll make you whole at that point. That's an end of lease payment. So these maintenance cash flows, reserve collections, reimbursements, end of lease payments are an intrinsic part of an operating lease agreement. And so they're cash flows that will come into the trust. So some of the cash flows come in, they can be meaningful as we showed. And as well, the trust needs to be able to pay out some maintenance cash flows. And so that's a basic synopsis of how maintenance works and why it's important. And the trust needs to be able to fund this.
I would just add a simple, observation. I mean, maintenance reserves have always been a part of the leasing business, and will always continue to be as well. I think, though, what we've seen in ABS 3.0 is more transparency of that within the ABS structures, and so now investors are now seeing it and focusing it, and companies like Alton, are providing that information to the investors to understand, that in addition to basic rent, the maintenance reserve ins and outs is absolutely critical to the success of managing the portfolio for the investors.
Okay, well, that's fantastic background, because we've had two questions around the issue of, can you explain the difference between the senior maintenance account and the junior maintenance account?
Sure. So the maintenance reserve accounts in the waterfall structures, these are sort of steps in the waterfall, and they're effectively set up so as to permit or to ensure that when an expenditure comes up, let's say when a lessee makes a reimbursement claim for maintenance, that the trust has sufficient liquidity, sufficient cash that's available to make that payment. So the way that each of those reserve accounts will work is that there will be a forward projection, let's say over the next 12 or 18 months. There's a requirement that, or an expectation of certain maintenance payouts will be required. If that maintenance payout is required in the next month, then there's a requirement that 100% of the cash amount needs to be sitting in that account. If that payment is in 6 months of time, perhaps it's a lower amount needs to be held today to effectively build up the cash over a period of time to make that reimbursement. Now, the reason that there are a senior and a junior maintenance reserve account is effectively that the senior reserve account has a longer sort of look forward period than does the junior account. So the senior account will effectively ensure that a certain amount of cash is collected, but the junior account is effectively sitting there sort of in reserve, and when reimbursements are particularly spiky or particularly lumpy, funds will flow into that junior account to make sure that there's enough cash that's trapped to make the full reimbursements out to the lessees. So it's really a structural feature that's designed, both designed sort of in parallel to make sure that those funds are available to make the commitments back to the lessees.
Okay, great. Thank you, John. Another question sort of related is, what is green time leasing?
Sure. Green time leasing is traditionally, we would associate it with the engine leasing. And when we talk about green time, it's the operational time, or the operational time that an engine will have to continue to be operated and leased until a major shop visit is required. So if you talk about an engine that can run for another 6,000 flight hours, we would talk about, toward the end of a lease, we talk about a green time lease as kind of leasing out that engine for that 6,000 hours. And then typically at the end of a green time lease, there's going to be sort of a decision to part out. So it's running out the last remaining maintenance or utility value on the asset.
Okay, I think you've kind of touched on this already, but the next question is that in the current market, few airlines are willing to pay maintenance reserves. So how does that impact ABS deals or the ABS market?
Yeah, I mean, I think I mean, in general, no airline wants to pay maintenance reserves, and all lessors want their airlines to pay maintenance reserves. So it's this, negotiation that takes place. I think that's generally true for the stronger credits. So we've seen a lot of sale leasebacks and with the U.S. majors and other strong LCCs, and the lessors have signed up those deals, and those deals will probably perform just fine. I'd say in the current ABS market, what we've seen is that a lot of the aircraft that have come into the ABS financings have used those end of lease payment structures, and there's no particular challenge or risk. Whatever the maintenance cash flows are, they do need to get structured around. I would say that in terms of the bond issuances, the rating agencies generally take a pretty, their assumptions are that perhaps 75+% of the leases default. And so what you can see is when we're running the stress cases and it's an end of lease payment structure, there's going to be a significant amount of sort of value that's wiped out in the rating agencies' stress runs. So what we can see is that sometimes some of the deals will benefit from having additional security coming in through the form of maintenance reserves or maintenance letters of credit. Evan,
Peter, yeah, I would just make the following comment. Now, if you look at the waterfall schedule that John went over in structuring, you can see that the maintenance reserve payments are very, very high in the waterfall. So I think it comes after interest to the A and interest to the B in most cases. So when there's a real shortfall of cash coming in, that's the big kind of the big risk in the deal where lessees had been paying reserves in, let's say MR payers had been paying into an account, rather than being an escrow, a lot of that money has flowed through or gone into the maintenance reserve account. But as John said, the schedules are a buildup of cash to meet an event that's occurring in the future. In some cases, that money has stopped. And so you may have only had 50% of that money, needed for the event that's going to occur in 6 months come in. And now, your lessee is just said, look, I don't have any money left. I can't do anything. I can only pay you X or Y. And so again, the pandemic environment has just brought out, a drastic behavior of survival with many of the lessees. And, hopefully this is now it'll catch up. But in some cases, you have situations where the lessee has basically just said, look, I can't pay anything now. I can start making it up, a couple of months from now if things pick up. But for the lessor and for that event, that's a calendar event, it's kind of a hole in, right now for what could possibly happen. So we're sort of in that mode right now of wait and see. We think things will catch up again and cash will start coming back in. But in some cases, you could have a situation where, the event hits and because of the pandemic and because of lessee credit problems, there just hasn't been enough cash coming in yet to meet that event. So these are things that are, again, going to play out in the structure and, will affect, how the rating agencies evaluate the bonds.
Okay. Another quick question for you, Evan. You mentioned earlier that the trusts have boards and so forth. Is it the board that decides whether to enforce on a defaulting airline or repossess an aircraft?
Well, I think basically they have the ultimate say, but the servicer really does the work. They're the ones that are closest to the credits, closest to the assets. They will present situations for approval to the board based on their recommendations. And I think for the most part, the board will go along with what the servicer is recommending as the action to be taken. So, if the question is, should we go in and grab that plane, that the board ultimately has to give their approval, to that action.
Okay, I'll take one more question from the audience, then I just have one quick question for you that I'd like to ask for myself. Given structural changes post-COVID, are there sufficient changes in the market per se that you would say that we're heading to ABS 4.0, or is that premature?
It's a good question. I think initially, as John pointed out, I mean, if you look at the deals that were done in 2021, much better, much stronger credits, longer leases, newer aircraft, no reserve payers. Basically, it's a pretty safe deal. However, that's not, in my opinion, that's not really what the ABS market is there for. I mean, those credits, Delta, Qatar, I mean, they could go out and they could issue bonds on their own. They don't need the ABS market, to participate. So they did sale leasebacks, and then the new lessors of those aircraft then, had the ability to put those airplanes into a trust. I think ultimately we really need to get back to, the primary, use as a portfolio management tool for the big lessors, to stimulate trading, to stimulate, transition from new to mid to old. I think what needs to be, we need to see a reset in values, and we need to set a reset in lease rates. And then, once we have those resets, then we'll know what the projected cash flows are going to look like. I think right now there's still a lot of uncertainty as to, it's almost impossible to do any forecasting, beyond what's initially contracted. So until we have a better sense of what the forecast band is, I think it's going to be tough to do, some of the portfolio management type of transactions that we saw earlier. So I mean, I know there's been a few. Castle Lake did that. They got that deal. They got the refinancing done, which is great. And they're gonna, believe me, that all these guys are going to be pushing really hard to get it done. And it's going to be a question of pricing and structure. But I think right now, like everything else, I mean, did we ever think 9/11 would happen? No. Did we ever think Great Recession would happen? No. Did we ever think a pandemic would happen? No.
Yeah.
So, I think we're moving into the next phase, to accommodate what the global travel world's going to look like.
Okay, well, look, thank you very much for that. And before I ask my final question, I will apologise to some people in the audience who have submitted questions, but just in the interest of time, we do need to wrap things up. My final question to both of you is that if somebody listening or watching this subsequently wants to follow the market, wants to become an active trader and investor, is there anything you would encourage them to read, learn, study on a regular basis to get up to speed and to stay up to speed in this market?
No, John, I mean, I would say, follow the rating agency reports. I think they really do a good job with their reports. There's a lot of good information coming out, from lessors, from Alton, that people should take a close look at.
Okay, or they can call you for advice if they need that. John, any quick ideas or suggestions in terms of reading and analysis that people can follow?
Yeah, I mean, the investment market, I mean, it's opaque to the to the retail, largely opaque to the retail investor. It's really an institutional sort of market for for investors. The desks that are at the big banks that are trading the paper will issue sort of research reports. The notes and deals are covered by all the big major banks, and so if you can develop a relationship there with some of the folks on the trading desk and the research side as well, that's probably a good point to understand sort of exactly where the market is at a given point in time.
Okay. Well, look, with that, in the interest of time, we should wrap things up here. Thank you very much to Evan and to John. Really appreciate you all your effort, and to the audience for staying with us throughout. And really appreciate everything, especially those who are going to watch it online subsequently. We appreciate your attention, and thank you very much to everybody.
Okay, great. Thanks very much, everyone. Thank you.